Hey everyone, welcome back. Today we're diving into something I know a lot of you are really interested in: dividend stocks, but specifically ones that you can buy for under $100.
Okay.
We found this great article called The Smartest Dividend Stocks to Buy with $100 right now. And we're going to kind of take a deep dive into it.
Sounds good.
We're going to break down the ideas, get a feel for the companies they're highlighting,
Yep.
and help you decide if any of these are worth taking a closer look at.
Makes sense.
And to help us unpack all this, we've got an expert here who can, cut through the financial jargon and give us some valuable perspective.
Happy to be here. I think exploring dividend-paying companies, especially in this market, can be really eye-opening.
Absolutely. Now let's start with the basics.
Okay.
Dividends. What are they? Why do companies pay them? Why do people get so excited about them?
Right. Well, the simplest way to think about it is imagine you own a piece of a company, right?
Mm-hmm.
And that company is doing well, making profits. Dividends are a share of those profits that the company pays out to its shareholders, like you.
So it's like getting paid just for owning the stock.
Yeah, exactly.
That's why people love them, especially if they're looking for that passive income.
Exactly. It's that steady stream of income. And if the company's doing well, those payments might even increase over time.
That's the hope. All right, so the first company on the list here is Ares Capital.
Great.
It's trading around $23 a share.
Yeah.
And boasts an 8.4% dividend yield.
Hmm.
That definitely catches the eye, but what's the catch? Why is it so high?
Well, the yield's connected to how Ares Capital is structured. It's a business development company, a BDC for short.
Oh, a BDC.
Yeah.
What's that?
So BDCs have unique tax rules that require them to distribute most of their earnings as dividends to avoid those corporate taxes.
Uh-huh. So that's why the payout's so high.
Right.
But what does a BDC actually do? What's their business?
Essentially, they act as lenders, providing financing to mid-sized companies that might not qualify for traditional bank loans.
Oh, interesting.
Yeah. And Ares specifically focuses on senior secured loans.
Senior secured loans.
Yeah, which are considered less risky than unsecured loans.
Oh, I see.
Think of them as a bridge between these companies needing capital and investors seeking higher returns.
And how big is this bridge? What's the potential market for something like that?
It's huge. Just for companies with revenues between $100 million and $1 billion, it's a $3 trillion market.
Wow.
And if you include larger companies, it jumps to $5.4 trillion.
That's massive.
Yeah.
So where does Ares Capital fit in all of this? Are they like a small fish in a big pond, or are they a big deal?
Oh, no, they're actually the largest publicly traded BDC in the U.S.
Oh, wow.
Yeah, they've got a great track record of dividend growth and returns, and they have these deep relationships in the market, which helps them find good deals and manage risk effectively.
The article even mentions that their total returns over the past 10 years have outperformed their rivals.
That's right.
But of course, every investment comes with risks. BDCs can't be completely risk-free, right?
You're exactly right. No investment is without risk. A BDC's performance is tied to the health of the companies they lend to. So a big economic downturn could definitely impact their ability to keep paying those dividends.
So you got to weigh those risks against that high yield.
Absolutely.
All right, let's move on to another company with, I'd say, a different risk profile.
Okay.
Enterprise Products Partners.
Yep.
And this one's much more affordable, trading around $34 a roop. Well, actually, it's not a share, it's a unit.
Right. That's because they're structured as a master limited partnership.
An MLP, what's that?
It's basically a hybrid between a corporation and a partnership.
Oh, interesting.
It can have potential tax advantages, but it also has some complications, particularly with taxes.
Like what?
Well, instead of the usual 1099 forms, MLPs issue K-1 tax forms, which can be a little more complex.
So that's something to be aware of if you're considering investing in an MLP.
Definitely something to research further.
Okay, so putting aside the unit versus share and the tax stuff for a minute, what's enticing about Enterprise Products Partners? What makes them stand out?
Well, they have a dividend yield of over 6.35%. This is already pretty attractive.
Mm-hmm.
But they've also increased their distributions for 26 years straight.
Wow. 26 years in a row, that's consistency.
Definitely shows a strong commitment to their shareholders.
Absolutely. Now, their article mentions that they operate in the midstream energy sector.
Right.
What does that mean? And why should an investor care about that?
So midstream companies, they're not drilling for oil themselves.
Okay.
They're more about transportation and storage.
Ah,
Think pipelines, storage facilities, those kinds of things.
So they're kind of like the logistics experts of the energy world.
Exactly. They're the link between producers and consumers, making sure those energy products get where they need to go.
And that makes their business model more stable, right? Even during recessions or tough economic times.
Exactly. Energy is always in demand no matter what's happening in the economy.
But doesn't their revenue still depend on the price of oil and gas? Wouldn't a drop in prices hurt them?
That's where it gets interesting.
Okay.
Their cash flow isn't actually directly tied to those price fluctuations.
Oh, really?
Yeah. They mainly charge a fee for using their infrastructure, so they're somewhat shielded from those wild price swings.
So that fee-based model makes them a bit more stable.
Exactly.
But what about inflation? That's a big concern these days. Does that impact them?
It does, but they've got a built-in buffer.
Yeah.
About 90% of their long-term contracts have price escalation provisions.
Price escalation provisions.
Yeah, so as inflation rises, their rates can adjust too.
Smart.
It helps protect their profitability.
The article also points out their attractive valuation with a forward earnings multiple of 11.6.
Yep.
What does that tell us?
Basically, it compares their current stock price to their expected future earnings.
Uh-huh.
And a lower number like that can sometimes suggest that the market might be undervaluing them a bit.
No, we do want to be transparent here. The article does bring up politics.
Oh, okay.
It suggests that a second Trump administration could be good for midstream companies like Enterprise. Now, we're not here to endorse any political stance, but it is something to consider.
For sure.
How might potential policy shifts impact the energy sector, and what should investors watch out for?
Political and regulatory changes can definitely have a big impact on any industry, and especially energy.
It's a reminder that investing isn't just about the numbers, it's about understanding the bigger picture.
Absolutely. Staying informed about potential policy shifts is key.
All right, so we've looked at Ares Capital, the BDC giant focused on lending, and Enterprise Products Partners with their steady, fee-based energy business.
Yep.
Feeling informed. Good. Because we have one more company to explore.
Okay, who's next?
It's Pfizer. I'm sure you've heard of them.
Oh, yeah, definitely.
What are your initial thoughts on Pfizer as a dividend stock?
Well, they're a huge name in pharmaceuticals, a global company with a big reach.
And you can get a share for under $27 right now.
Especially considering they're offering a forward dividend yield of 6.5%.
That's pretty significant.
It is. What's driving that yield?
Well, they've got a long history of paying dividends, and they're committed to maintaining and even growing those payouts.
Which signals confidence in their ability to keep generating profits.
Exactly. Even with challenges, they believe they can deliver.
That commitment to their dividend is definitely reassuring.
Yeah, it provides stability for income-seeking investors.
But the article does mention some potential challenges, especially around patent expirations.
Right.
Several of their key drugs are going to lose patent protection soon.
That's always a concern for pharmaceutical companies.
What does that mean for Pfizer's future? Should investors be worried?
When patents expire, generic competitors can come in, and that can really impact revenue.
Yeah, it's a big deal.
It's something to consider carefully when looking at a company like Pfizer.
And on top of that, the Inflation Reduction Act could affect their pricing power too.
It's true, there are some headwinds.
So with all that in mind, is Pfizer still a smart investment?
Well, there are challenges, but they also have strengths.
Like what?
They're not just sitting around. They've got a strong pipeline of new drugs in development.
So they're innovating, trying to stay ahead of the curve.
Exactly. And some of their newer products are already doing really well.
Okay, so they're adapting to the changing landscape.
It seems that way.
But is that enough to outweigh those patent risks and pricing pressures?
Well, their stock is trading at a pretty low price-to-earnings ratio right now, which might suggest it's undervalued.
Interesting.
It really comes down to how much risk you're comfortable with and how you see them navigating these challenges in the long run.
All right, listeners, there you have it. 3 very different dividend stocks to consider. We'll be back in a moment to break down the key takeaways and leave you with some final food for thought.
Sounds good.
See you after the break.
See you.
Welcome back. It's been really interesting looking at these 3 very different companies.
Yeah, for sure.
You've got Ares Capital, that BDC giant we talked about, focused on lending. Then there's Enterprise Products Partners with their steady fee-based model in the energy sector.
Right.
And of course, Pfizer, the pharmaceutical giant, dealing with those upcoming patent expirations.
It really shows you how diverse the world of dividend-paying companies can be.
It does. So for someone who's just starting to explore dividend investing, what are the key takeaways from our conversation? What are the big things to keep in mind?
I think the most important thing is understanding the why behind a company's dividend.
Okay, the why.
Like, is it a sustainable payout based on good earnings and a solid business?
Uh-huh.
Or is it maybe a sign that they're struggling to attract investors in other ways?
So don't just chase the highest yield without thinking.
Right. Look beyond that number and really understand what's driving it.
Makes sense. So it's not just about the dividend, it's about the company's overall performance, too.
Exactly. Are they growing their earnings? Are they managing their debt well?
Right.
Do they have a history of increasing their dividend? Or are they always cutting back?
Those are all good signs to look for.
Yeah, they can tell you a lot about the health and stability of the company.
So you want a well-managed company with a good plan for the future, not just a high dividend right now.
Absolutely. Because a high yield doesn't mean much if the company's not going to be around in a few years.
And we can't forget about industry trends, right?
Oh, yeah, that's huge. Is the company in a sector that's growing? Or are they facing big challenges?
Like we talked about with Pfizer, patent expirations and those changing regulations can really hurt a pharmaceutical company.
Yeah, even a giant like Pfizer isn't immune to those forces.
And in the energy sector, there's that shift towards renewable energy.
Right, and that could create both opportunities and challenges for midstream companies like Enterprise.
Their fee-based model gives them stability, but how will they adapt as the energy landscape changes?
That's the million-dollar question.
So it's about anticipating those long-term trends and how they might affect a company's ability to keep paying those dividends.
Exactly. You got to think long-term.
Okay, so we've talked about the dividend, the company's performance, and industry trends. What about risk?
Well, every investment has risk, right? And dividend stocks are no different.
Of course.
You have to understand the specific risks for each company.
Right.
With BDCs like Ares Capital, if the companies they lend to start having trouble, that's going to impact Ares earnings and their ability to pay dividends.
So even though they focus on those senior secured loans, which are supposed to be less risky, there's still a chance things could go wrong if the economy takes a hit.
Absolutely. There's always some level of risk.
And what about Enterprise? With that fee-based model, they're somewhat protected from energy price swings, right?
To a certain extent.
But they're still exposed to things like regulations, pipeline problems, and that long-term shift to renewables.
It's true. There are always factors outside their control.
And then Pfizer, with those patent expirations and potential pricing pressures, they face their own set of risks.
It's a different kind of risk profile.
So it's not about avoiding risk altogether. It's about understanding the specific risks for each company.
And deciding if those risks are worth taking for the potential rewards.
Which brings us to the question of risk tolerance, right?
Exactly. How much risk are you comfortable with? What are your financial goals?
Because everyone's different.
Everyone's got their own situation.
So if someone's listening and thinking, dividend stocks seem like a good option for me, what should they do next?
I always say, do your own research on any company you're interested in.
Okay.
Dig into their financials, read analyst reports, and see if they fit with your investment style and your risk tolerance.
It's about taking ownership of your investments, not just blindly following someone else's advice.
Exactly. Make informed decisions.
And remember, these 3 companies are just a starting point, right?
Oh, yeah. There are so many other dividend-paying companies out there.
It's a huge world to explore.
It is. And it's always changing.
But with a little effort, you can find the companies that really fit your needs.
Absolutely. That's what it's all about.
That's what we're all about here on the Deep Dive.
Empowering you with knowledge.
Giving you the insights you need to make smart decisions.
Because knowledge is power, especially when it comes to your money.
It really is. All right, let's wrap up this deep dive with a final thought for our listeners.
Okay.
What's the one question they should ask themselves as they consider these dividend stocks?
Here's the question. Are dividend stocks the right fit for your investment strategy?
That's a good one.
And if so, which of these companies, if any, deserve a closer look based on your goals and your risk tolerance?
I love that. It brings it back to the individual and their own needs.
That's what it's all about.
There's no right answer for everyone.
No, it's about finding what works for you.
Aligning your investments with your overall financial plan.
Exactly.
And your vision for the future.
Dividends can be a great tool for income and building wealth. But you want to choose companies that you believe in that fit your strategy.
It's about creating a portfolio that reflects your values, your goals.
It's a journey of self-discovery. You learn about different companies, different industries.
And ultimately, you learn more about yourself.
Exactly. And what you want to achieve.
It's not just about numbers.
No, it's about building a future that aligns with your aspirations.
It is exciting.
Yeah.
So any other parting thoughts for our listeners as they embark on this journey?
Well, I think sometimes that journey starts with a simple question.
Okay.
What kind of dividends do I want in my life?
That's a powerful question.
It goes beyond just financial returns.
Huh.
It's about what we value, what we want to create in our lives.
Beautifully said.
It's about taking control of your finances and shaping your own destiny.
I love that.
They can all start with that question.
What kind of dividends do I want in my life?
Exactly.
That's a great note to end on. Thanks for sharing your wisdom today. I know our listeners have gotten a lot out of this conversation.
My pleasure. Always happy to dive deep into these topics.
And to our amazing listeners, thanks for joining us on the deep dive.
Keep those questions coming.
Keep learning.
Keep exploring.
And keep diving deep.
We'll be here to guide you every step of the way.
Until next time.
See ya.
You know, it's funny how we started talking about finding dividend stocks under $100.
Right.
And we ended up going down this rabbit hole of BDCs and
K1s.
K1s. Yeah, we covered a lot of ground, even touched on like the future of energy and what's going on with Big Pharma.
It really shows how everything's connected, right?
Yeah. A simple idea, like getting paid to own a stock, can lead you to some pretty complex stuff.
It can. And I think that's what makes investing so interesting. It's not just about numbers. It's about understanding how businesses work, how industries change, and like how the whole economy fits together.
It's about seeing the bigger picture.
Exactly.
And a high dividend might catch your eye, but like we said before, you got to dig deeper.
Yeah.
You got to understand the business, their financials, the whole industry.
It's like peeling back the layers of an onion.
It really is.
There's always more to uncover.
Always. And that's why doing your own research is so important.
Absolutely.
Don't just take someone's word for it or rely on a headline.
No way.
Dig in and form your own opinions based on what you find.
That's the best way to learn.
Absolutely. We've given our listeners a good starting point with these three companies.
Yeah, Ayers, Enterprise, and Pfizer.
We talked about their good points and their bad points, what they're doing well, and what challenges they face.
It's a good overview.
It is. But in the end, it's up to each investor to decide if any of these companies fit their goals and their risk tolerance.
That's the key, right? There's no one perfect investment for everyone.
Nope. What might be great for one person could be totally wrong for someone else.
It all comes down to your own situation, your goals, and how much risk you can handle.
That's the beauty of investing, though, isn't it?
What is?
It's a personal journey. You learn, you explore, and you make choices that shape your financial future.
I like that. It's about taking control.
It is. And sometimes that journey begins with a simple question.
Like what?
What kind of dividends do I want in my life?
That's a good one.
It makes you think beyond just the money.
It does.
Yeah.
It gets to what we truly value, what we want to create in our lives.
Beautifully said. I think that's the perfect way to wrap up our deep dive today.
I agree.
It's been a pleasure exploring these companies with you.
Likewise.
And to all our amazing listeners out there, thanks for joining us on this adventure.
We hope you learned something new.
We hope it got you thinking.
It maybe even inspired you to do some more exploring on your own.
The world of investing is out there waiting for you.
So keep learning, keep asking questions, and keep diving deep.
We'll be here to guide you every step of the way. Until next time.
See ya.